committee meeting recap. We'll get started here soon, but in the meantime, please continue to submit your questions and we'll continue to monitor those throughout the chat, throughout the duration of this webinar and address those at the end. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenter today by using the chat feature found at the bottom of your screen. You can find the chat feature by clicking the three dots on the bottom of your screen if you are on a mobile, or selecting chat if you're joining from a computer. Before we begin, I'd like to introduce our economist on the call today, Mr. David Widmar, co-founder and managing partner of Agricultural Economic. David was kind enough to glean the information from the meeting yesterday, interpret that data for us, and share his perspective on what yesterday's findings will mean for the overall economy and at the farm gate. As a reminder, this webinar is intended for informational purposes only and is not public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. So without further ado, Mr. Widmeyer, I will turn it over to you.
All right, thank you so much, Marcus, for that introduction. Thank you all for joining us today. And as Marcus said in the introduction, our goal here is to share a little bit about what we learned from the Fed's recent meeting. And they had this summary of economic projections where they share a little bit about their own forward-looking expectations. And I think what's really valuable for they call it the SEP, what's really valuable for the summary of economic projections is it's not a great forecasting tool in and of itself, but it's really valuable to help us understand the base levels for their expectations. And so if something were to happen in the economy, to the upside or the downside, we can lean back on that summary of economic projections as a little bit of a guiding, a little bit of a roadmap. So they tell us where they're planning on going, and then we can update with how things start to unfold and play out. So that's a really valuable piece here. So again, the goal here is to try to pull this together in a way to help you understand what the farm level implications for some of this happens, because the Fed makes an announcement and eventually it works its way throughout the economy. We just want to share some insights and help you think about that and the implications for your operations. Um, I want to start this off by sharing this quote. It says, "There are decades when nothing happens, and then there are weeks when decades happen." And this is applicable in a lot of ways. But if you think back to, the economics that you've learned about in high school, or maybe in a college course, or maybe just economic speak that you've picked up throughout your career, it seems like in the last few months, every single term that you might have ever heard an economist say has been thrown out. We've heard inflation. We've talked about tariffs. We've talked about the debt ceiling. We've talked about a deficit. We've talked about stagflation. All of these things are starting to come up at once, and so it's hard to keep track of all these moving pieces. And I think that's one of the challenges that the Fed's got to navigate with in the next coming months. And so I just want to again recap what we learned yesterday's meeting, the most current meeting, and then think about how this is going to play out and provide you with some of those definitions along the way as well. So the first piece here is it's part of the table from that summary of economic projections. This is the table that you see quoted and cited the most. And I'm going to say at first glance, it paints a slightly weaker economic outlook for 2025 into 2026. The big story here is the Fed hasn't changed there wasn't, I guess, a big tidal shift in what the Fed position, what the Fed's actions were. I think they positioned themselves in a little bit of a defensive position. So we're going to talk a little bit about that. The Fed in Jay Powell's comments was very clear that they wanted to be well positioned for whichever direction they needed to act. If we got ourselves into a recession, they wanted to be able to have some space to support the economy in that. If we got into an inflationary period again, they wanted to be in a position where they could combat that. So they didn't move a whole lot, but they're definitely taking this, how can we be in a good position, a strategically good position to move forward. So let's break down some of these projections. And what's valuable here is the Fed includes their previous projections back in December. So the first piece here, inflation adjusted GDP cooled a little bit from 2.1 to 1.7%. They're also looking at unemployment rates, again, ticked a little bit higher. Not necessarily of a concern in the overall magnitude, it's still a historically uh, low unemployment rate, probably even a tight labor market in historical context. We also see the PCE inflation. I grabbed the headline inflation number here. Core inflation, if you just drop down one rung here, it also has creeped up a little bit. So you have this situation of things aren't quite moving um, in a favorable direction, not dramatically worse off, but just everything kind of went just a little bit unfavorable, a little bit slower economy, a little bit higher unemployment, a little bit higher inflation. Um, that combination is a little bit tricky for the Fed to try to navigate. But I think that was just sort of a reflection of all this uncertainty. And one of the things to keep in mind about uncertainty really means we have a wider range of possible outcomes. And so I think that's what we see here is just a wider range of possible future economic outcomes, and the Fed has to position that. Here is that probably the headlines you probably see is the Fed um, this median. So all of these are median expectations. And what the median means, it's not an average, it's different than the mean or average. Median means we lined up all the expectations from lowest to highest, and we said where's the value that's in the middle? And so we report that middle. So what median doesn't tell us how wide of a range there is. It tells us something about just sort of we throw out the most high and the most low. We say, well, this is sort of the middle of the road expectation. So the middle of the road expectation here for the Fed funds rates in 2025 is still unchanged from back in December. Same for 2026 expectations. If we look at the dot plot here, we start to see a little bit. If you remember that dot plot back in December, we see the distribution of these dots tighten up a little bit. And I have another graph here I want to show that to you for. And when I updated, the crossed out values are where we were back in December. Here's where we are today. What we start to see here is that there were a few participants who thought we might see a full 100 basis point cut. It wasn't the prevailing consensus, right? But it was a few folks who were expecting significant rate cuts. And then there are, a handful who thought there were going to be fewer than 2 rate cuts. So 2 rate cuts is that median expectation. That's unchanged. But we start to see this general shift upwards. The median is still somewhere in here. We just pushed a few more participants up higher. So the median has shifted just a little bit. It's still in that same window. It's just shifted up just a little bit. So now 4 participants think there'll be no cuts in 2025. And then there's a few who think there will be as many as 3 cuts. So again, the big idea here is there's still a pretty wide range for being a quarter of the way through the year, or almost a quarter of the way through the year. There's still a pretty wide range of expectations for where interest rates are going to be headed. Again, the other thing here is another wide range, 150 basis points here for 2026. The idea here is that as we look to the long run expectations still are median around 3%. Again, what that tells us is we were in this era between 2010 and 2022 where we spent a lot of time with the Fed funds rate, well below this threshold, well below this 3 or 2% threshold. And so we're not looking to go back to those levels. In fact, there might be a little bit expectations going to take us a little longer to get to that 3% level. This other chart, this is a chart that I want to spend just a little bit of time talking about. Let me move my stuff out of the way on my screen. This is a little different way of looking at those current, that dot plot. It's a little different way of looking at the dot plot in that we can show current projections in those dark blues and the earlier projections in these light blues. Again, this is pointing to that situation I was pointing to earlier, whereas there are these folks who had these expectations for big rate cuts, both in 2025, 2026, and 2027, that is not nearly as expected today. And so I think what we saw is that the shift here, the median didn't change, but we sort of shifted these expectations up a little bit. So probably a little less optimism for dramatic rate cuts. Again, the middle of the road expectation is the course is the same, but these tail events put a little more probability of these small changes and took some of these low changes and put those to the back burner here for these projections. I want to shift gears here and talk a little bit now about the rest of the economy and some of these expectations. Inflation is going to be a topic, I think, just about the time as we thought inflation was getting behind us when we talked back in December about this. It looks like inflation is going to come up, and tariffs might be kind of the most obvious way that inflation is being talked about. But I want to spend just a little bit of time of sharing why I think inflation started to raise its ugly head here in 2024. Now that we have a little bit of data. So this measure here on this chart, this is the PCE index. This is the Fed's quote unquote preferred measure of inflation. This is the measure that they're watching to get back to 2%. We've also had this, we've measured these changes on a year over year basis. And so you can see that across the whole year in 2024, we had a 2.5% inflation. That's down considerably from 3.8% and 6.6% in the preceding years. Looking at sort of a monthly measure of this, we got as high as, 6.7, 6.8, and even 7.2% at different points in 2022. So first observation is the inflation outlook, as we've mentioned a lot of times before, is dramatically improved. However, we have not got back to that threshold of 2%. We have not quite got to that 2%. So I think that's part of the reason before this meeting why the Fed has been a little slower to get interest rates lowered is that inflation has been a little bit stubborn. The last 50 basis points has been a little bit stubborn. You can see that, we had a bit of a downturn there in 2024. That's where we had a lot of optimism about, more aggressive rate cuts, and then it started to drift a little bit higher. Now, this measure is where you see inflation measured most often on a year over year basis. But if we really want to understand what's going on kind of on a pulse level, right? This is a hypersensitive measure. We can use this hypersensitive measure and we could talk about inflation and we can measure it on a month over month change. Again, we have to be careful with this because it moves around a lot. And so we want to make sure we're not jumping to conclusions that aren't supported by the data. But if we start to see a trend, I think that's a really important indicator. You can see back in 2020 all the way up to 2022, this measure trended higher, and that was a real concern for the economy. And that's when that's where the lights were starting to flash on the dashboard, telling us, hey, there's a lot of warming up in the economy. Let's look at where we are in 2024. Month over month measures showed economy was at its coolest about 10 months ago, back in May 2024. And there's been this slow warming of the inflation indicators. We saw a brief dip in May, and when we're back in May, it's like, oh, okay, maybe this September and October were the anomalies here, right? Maybe this is just a short term, and we're going to settle in somewhere around here. It now looks like with December and January data that there was a little bit of heating up in the economy long before we started having these conversations about tariffs. So if inflation starts to be a little bit of a concern here in 2025, I think it's a combination of this trend that we set into play in 2024, and then it's maybe exacerbated by these tariff concerns. Just a real quick point, this measure is really hard to benchmark, but the idea here is at this threshold right here, this is about double that Fed's goal of 2% annual inflation. So we need to see things, much closer to down here, which is where we were hoping we were going to settle out back in the end of 2024. It turns out, though, we might be somewhere up north of that. And I think this could start to be a little bit of a measure. If you really want to think about inflation and the tariff effect, this is going to be where a lot of focus and attention is going to be. Also, want to talk about the yield curve. The yield curve has been all over the place. Started this by saying, goodbye to the yield curve. Well, maybe the yield curve is coming back again, but the idea of an inverted yield curve is that the short-term rates are higher than long-term rates, and that's something that we don't generally expect. Especially as a base rate, it's not uncommon, but we generally expect that long-term rates to be higher, given all the uncertainty, than a short-term rate. But we had a pretty long stretch here of a yield curve inversion, and then we saw, early in 2025 and late 24, early 25, that inversion unwound. So we had a somewhat normal yield curve. The spread wasn't as wide as maybe we initially thought, but it was starting to you know separate there, and then it sort of shrank back in here. So I think the yield curve is still an open question. The big takeaway here is that that relationship between long-term and short-term money has still been, a pretty small spread, not quite negative here, but not also at the historic levels. We're going to keep continuing to watch an eye on this. But again, one of the ideas that I hope I can get across today is that we sometimes think about the Fed moving the Fed funds rate, and then everything moves nicely throughout the economy. And it doesn't quite work that way. The Fed has a few levers that it pulls, and the Fed fund rate is one of those. But then it works its way through all of these debt markets. And so, you know, what's the supply and demand for these 1-year treasuries, and what's the supply and demand for 10-year treasuries, and what's the supply and demand for a 15 or 20-year farmland note, and what's the supply and demand for a 30-year home mortgage. And so all of these, interest rates are unique supply and demand curves, and so it takes a long time to work its way through the system, and we'll continue to see how that progresses and that moves forward. One other piece of news, I guess, out of the uh, Fed's meeting is that they're going to slow the pace at which they're tapering their um, their quantitative tightening. They're going to slow the pace of this quantitative tightening with respect to shrinking their balance sheets. When there's concerns about the economy, they can um, expand their balance sheet by buying assets, and that puts more cash or liquidity into the markets. And so we see that they did this after the 08-09 recession, and then we had these rounds of quantitative easing. We got the balance sheet up quite a bit, and they tapered it, or they did some quantitative tightening back in here, and then we saw another jump up during the pandemic and the recovery areas. But since then, we've seen this general downward trajectory in this balance sheet tightening. They've pulled about $2 trillion out of the balance sheets. I think that's when they kind of have a set it and forget it approach here. They mentioned a couple of years ago they were going to start this, and then about a year ago they changed the pace and they slowed it. They slowed the pace, and now they've slowed the pace again. And so I think if you really want to watch the Fed, this is another indicator to keep an eye on what's going on in this respect. But they're still in this tapering phase. There's tightening phase, and they're just doing it at a little slower rate. The big question mark is what's the appropriate amount of reserves that the economy should have. And so they don't have a lot of work, or they're working on a bit of a thought piece and a forward guidance piece that we're going to see later in the summer about how they're going to continue to work through this. But this is one small change that the Fed announced at their meeting. I want to mention two definitions. I kicked this off by saying you've heard all of the economic terms that in the last few months that you maybe heard over your entire life, but there are a couple things that you might hear with respect to Fed speak around tariffs and inflation, and I want to just quickly define those for you to give you a little bit of a heads up. Pass through. This is how much a new tariff or a new announcement of tariffs might affect consumer prices. So let's just say, for example, there's a 25% tariff on the imaginary widgets that the economy produces and imports. So that just doesn't automatically raise consumer prices exactly by 25% because there's a whole lot of, again, things that this works through the economy. So there's a share of total widgets that are subject to tariffs. Maybe we uh, import a small share or a large share of all the tariffs, the widgets that we consume in this economy. Maybe we'll start to import from the tariff-free destinations. We can shift our trade patterns. Maybe new domestic production will come online. Maybe manufacturer retail profit margins will adjust, and maybe the changes in quantities demanded or purchased will adjust, and that's relative to that PCE measure. But in turn, it's hard for the Fed to start to exactly know what a 25% tariff on all imports from a specific country, how that will ultimately pass its way down to a specific consumer price. And so we have, and you can also think about the complexity between, food versus cars versus technology versus services. So there's a lot of ways to do it. But the idea of a pass through is what's that impact on those consumer prices. The next piece here is look through. These are very similar sounding terms, but it's a bit of a nuanced difference. That's why we call it Fed speak. Look through is how much of current inflation levels is from maybe a one-time pass-through effect. So what that means is if inflation, let's just say hypothetically, is 5% this year, how much should the Fed be considering that to be temporary versus a sustained situation in the economy? I showed earlier that warming up of inflation at the tail end of 2024. So the Fed's got to balance out, okay, how much of that inflation measure that we see later in 2025, so maybe Q2, Q3, how much of that is because of a one-time tariff hit that will work its way through the system? Those prices will stay elevated, but they won't continue to be increasing versus a warming up of the general economy. This is what makes the Fed's job really, really hard. One thing that we're going to see is that the Fed is going to sort of um, the look through in general, the Fed's policy through this is to not react to one-time pass-through events. And so if we see those prices jump up a little bit after these tariffs are announced and go into effect, the Fed's going to be somewhat slow and hesitant, and maybe uh, not even respond at all because they realize these are going to be short-term in nature, and we're not going to see that continued upward pressure in prices, 6 and 8 and 10 months down the road. So pass through, look through. Again, this is a little bit of a definition here, but I hope that will help you navigate some of the conversations that you're going to be hearing and thinking about over the next several weeks and months. Looking ahead at the timeline, there's going to be another Fed meeting in early May. There's going to be one in mid-June. We'll join you back again for another update of the summary of expectations. July, they have a meeting at the end of the month. And then September, they go back to the middle of the month. One of the timeline features that I wanted to point out here is in May 2026, we have a Jay Powell's second term as chair of the Federal Reserve is going to expire. And so the president will have the option of, I guess Jay Powell has the option of sticking around or retiring, and the president has the option of reappointing him or appointing a new chair. Jay Powell may not go away completely as his term as a board of governors. So he has another chair at the Federal Reserve, and a general, one of the 19 participants. That term ends in January of 2028. So Jay Powell is, of course, some of the political nature of that role is he's facing his term is coming up here quicker than I think most of us would have thought. We're probably going to be talking about this a year from now as to where his decision lands. So to wrap this up, a couple terms I want to keep in mind and share here. I think the Fed has been slow but deliberate in their actions, and I think they're going to continue to position themselves for that. And so we might see them act slow to respond to inflation to make sure it's not a temporary effect. Maybe it's more of a long-term concern. And they were slow to adjust when the economy and interest rates were coming. Inflation rates, excuse me. They were slow to adjust when the economy was cooling and inflation was coming down, but they've been deliberate. So I think this slow but deliberate has been a valuable mindset to keep in mind for how the Fed's been acting. I think the Fed's job is going to get incredibly more difficult as they start to navigate pass-throughs and look-throughs and this idea of higher inflation but a slowing economy. That could make all these things make the Fed's job a little bit harder to navigate. Interest rates expectations during this meeting shifted slightly higher. I don't want to overemphasize that, but I also don't want to I don't want you to be caught flat-footed by the headlines that are just saying, it's unchanged. I think there was some change. It just was a slight change, and it shifted just a little bit to the higher side. So that's all that I have here for my prepared comments, and I'm happy to open this up. I think we're going to open this up to all the questions that have been coming through, and appreciate you joining us, and I look forward to the questions.
Absolutely. Well, David, again, we want to thank you for your time, your contributions, and the insightful information that you were able to give us this morning. We did have a few questions that came into the chat. First one is the rates seem to be relatively high, even though the overnight federal rate is at 4.35%. So why have we not seen that drop? Could it be due to increasing profits?
It's a great question. So I think the question was about that that secure overnight financing rate, often shortened to SOFR. That's the replacement for the LIBOR index that we were using. Um, One of the issues that came up with respect to the Fed slowing its taper on the balance sheet was some concerns about the general liquidity in some of these markets. And there's a lot of pieces that go into that balance sheet and that liquidity. And one of the interesting angles to this is the debt ceiling. And so the Fed and the Treasury are working through this debt ceiling negotiation. And so one of the concerns here is that, and we got into this back in 2019, is that those overnight financing rates, they tend to show they can show a lot of stress if there's not enough liquidity in the markets. And so the Fed is really concerned about liquidity in the markets, and uh, those measures are really important also for the debt ceiling and how we're going to move forward. So I think there's a lot of moving pieces that go into that particular metric and that measure. And I don't have a great crystal ball there, but I think in general, if we see a lot of cash in the markets, that generally puts that index puts downward pressure on those rates for that overnight rate. If we see a lot of demand for cash, we see that rate tend to go up. So that is something I think the Fed is watching very, very closely, and that's part of that positioning that Jay Powell mentioned in his comments. They want to be able to respond however these issues go. So, like I said, I didn't talk about the debt ceiling, but I do think the Fed and the Treasury are all sort of wanting to dot their I's and cross their T's and make sure that they're responding to any sort of liquidity concerns that are being shown in the market ahead of that debt ceiling being approached.
Perfect. Thank you for that. We probably got time for one more. Um, with the Fed's latest decision, how will this impact borrowing costs for landowners over the next 6 to 12 months?
I think the Fed's decision um, this time was sort of a continuation of their expectations back in December. I don't think you have to update your playbook a whole lot. I think a bigger thing for you to keep an eye on if you're thinking about borrowing money for farmland uh, over the next year is to really keep an eye on those long-term rates and that relationship between long dated interest rates and short dated interest rates. That yield curve has had a way bigger impact on the interest rates you've been paying more than the changes in the Fed funds rate. I think we've seen the Fed funds rate come down a lot over the last year, and those long-term treasuries and those long-term farmland loans haven't adjusted nearly as much. And again, it's because of these relationships. So less on the Fed, more on the broader debt markets with respect to long-term interest rate expectations.
Perfect. Well, David, again, look, I appreciate your time. We all appreciate what you do. I want to be respectful for everyone's time. I think we got to end time here at 10 a.m. But did just want to set a reminder that this webinar will be shared and distributed to everyone here shortly. So again, thank you for your time and appreciate you all joining us.